Oops. All right, we're on. Welcome to 7 Ways to Increase Your ESOP Value. My name is Patrick Schmidt from Value Consulting Group, and with me I have Stephen White from Onyx Partners Group. We'll give a little more of an introduction here in a moment. Just wanted to let you know, if you're looking for continuing education credit, you need to be logged into the virtual conference under your own name, and you need to be signed in to collect continuing education credit via the NCEO's Google form. And you will have to answer the required polling questions during this session. If you need help, you can contact the email address at the bottom of this slide. And I do want to let you know that since this is not a live presentation, Steve and I will be watching the chat function on this presentation to see if you have questions, and we will try to answer those while you're watching today's presentation. So my name is Patrick Schmidt. I work at Value Consulting Group. We are a small business valuation and litigation support consulting firm located in Minneapolis, Minnesota. Our firm has 9 employees. We focus on business valuation. A large part of our business is employee stock ownership plan valuations, both on the transaction side and on the annual valuation side. We also do valuations for estate planning, for divorces, marital dissolutions, estate planning and gifting, as well as many other things, including litigation when shareholders get in disputes with each other. Stephen, would you like to introduce yourself?
Absolutely. Good afternoon, everyone. And as Pat mentioned, my name is Stephen White. I am the owner and managing partner of Onyx Partners Group. Now, we're based in northern New Jersey, and just a little bit of my experience in this particular field. I've been in the finance valuation space for almost 30 years now. It always shocks me when I say 30 years. But I started in investment banking, doing startup companies, .coms, moved into private banking, valuing companies, Fortune 500 companies that were interested in spinning off divisions to either for an initial public offering or for a privately held company, which then led me into wealth management, where I created an identity of working with small and mid-sized privately held companies, specifically for exit strategies, which brings me where I am right now of starting Onyx Partners Group. It's a small group of 4 of us. We focus our efforts primarily on valuations, not only just for ESOPs, valuation and consulting, but we also do acquisitions and sales of privately held companies, establishing buy-sell agreements, and practice management activities for companies that are either contemplating a merger from a strategic standpoint or contemplating just exiting out of the business. So I'm excited about being here today. And I'm sure you didn't come to this webinar to hear about our backgrounds, but you're really interested in knowing a lot more about this presentation about 7 ways to increase your ESOP value, which is an incredible presentation. I have to admit that this is not only just for ESOP companies, it really is, it's a great tool. This presentation is a great tool for those that are interested in actually being an ESOP company. So today, I'll walk you through the agenda, and it's 3 simple points that we're going to hit, but they're very deep as far as how you can enhance your value. We're going to start off with the centerpiece, what I like to refer to as the value-based management. And it truly is the centerpiece, and you'll understand that as we move along this presentation, because we're going to go from value-based management and lead into another leg, which is value drivers and value definition. And then we'll wrap up the presentation today by discussing something that is important for you and every business actually, is increasing cash flow and other ways to increase value. And just as Pat mentioned, if you have questions during the course of this presentation, down at the bottom of your screen, click on the Q&A, type in your question, and we'll be able to address it as we see it pop up as it's relevant to what we're discussing today. And if you choose to do it offline, of course, I know Pat's information along with mine will be at the end of the presentation. Feel free to reach out to either one of us so we can have a one-on-one conversation if that's necessary. Pat? Okay, so introduction to value-based management. So over the years, I'm pretty sure all of you at one point or another have read some articles or been a part of a management strategy approach that is designed to enhance your company or your organizational performance. And with that stated, there's a study that was done by McKinsey some time ago that you probably are aware or not aware that a lot of those strategies failed. And they didn't fail because of the mere fact that they were bad strategies. It was just the way that they were implemented, meaning that their KPIs, which stands for key performance indicators, they weren't explained really well to their team. And another measure that was offline with why they did not succeed and they ended up failing is because those KPIs were not aligned with the company's primary goal, which is value. So you think about this. If your team is not clear on your goals and they're not aligned with the primary goal of the business, which is to enhance value, why would it succeed? So there it brings you to value-based management. So VBM is a management approach which puts shareholder value creation at the center of the company's philosophy. And I love the way that KPMG Consulting defines it as the maximization of shareholder value, which directs the company's strategy, the structure, and the process, and then it governs executive remuneration and dictates what measures are to be used to monitor the performance. Next slide, please. So VBM is more than just your measurement system. And the guiding principle underlying the use of VBM then is the measuring and the rewarding activities that create shareholder value will ultimately lead to a greater share value. And coming from my background in investments and in finance, one of the things that we're always taught is that if it can be measured, it's important. So you may hear me say that a couple of times as we go through this presentation, because the founding principle underlining value-based management is the discount cash flow model of firm value. So just to give you just clarity as far as what discount cash flow model means, and I don't want to turn this into a corporate finance class, but I think it's important because I'm pretty sure at some point you've heard that terminology, discount cash flow, or you've heard DCF, or clear off your brains from college and so forth. You probably remember that. Just want to give you a quick overview of exactly what does DCF mean. It's a valuation method basically that's used to estimate the value of your company based on its future cash flows. And that's what we're here to talk about, your future cash flows. So the DCF analysis attempts to figure out what the value of your company is based today, based on the projection of how much money your company will make in the future. So the DCF is primarily considered, from my perspective, and I'm sure as far as Pat as well, is that it is the method of choice for ESOP valuations. Next slide, please.
Yeah, thanks, Stephen.
Mm-hmm.
Going along the lines for this value-based management concept, really what we're trying to do is we're trying to align the corporate goals with the basis for employees to do well. Figure out what should employees and what should management really focus on. And value-based management really says the key to increase shareholder value lies in the integration of strategic planning, performance measurement, and compensation. So all these things go together. And as Stephen mentioned, if you want to increase value, then you need to reward people for taking those actions and for doing those tasks that will lead to value creation, and compensate those people for making that happen. Once you align the goals of management and you align the goals of the employees towards value creation, you're much more likely to achieve that. So it aligns strategies, policy, performance, measures, rewards, organization, processes, people, and systems, which is pretty much everything, to deliver increased shareholder value. So it really should be the centerpiece of a company's strategy. It should be the centerpiece of those performance measures, the rewards for people, the processes. It really should go throughout the organization with all people rowing towards the same goal, and that is value creation. When we talk about finance, we talk about the goal of finance really is to increase shareholder value. And when you put that at the center of a company's reward system, you can see the real process. I work with a couple companies. I do some teaching for ExxonMobil. You may have heard of them. They're a small oil and gas concern in Houston, Texas, actually with operations all over the world. Another one, Thomson Reuters, which is both a publishing and a news organization. These are big companies that are focused on shareholder value. And if you look at their mission statements, you'll see that their goal, their primary goal, is to increase shareholder value. And they really feel that when your focus is on increasing shareholder value, that this goal really lifts all people. If you focus on increasing the value to the shareholder, you're generally going to focus on things that grow the company, that grow the opportunities for all the people working for the company, will be basically grow compensation for those people as well. So it really is a panacea of for a business that focuses on value management and value increase. So Stephen, I'm going to turn it back to you to get into some of the details. Here you go.
Good. Okay, so this particular slide is this one and the one that will follow are two of my favorite slides in this entire presentation. And the caption of this should explain the reason why. It reads, free cash flow is the ultimate driver of business value. And it is so true. I know that everyone thinks when you hear the word cash, you remember that old phrase, cash is king. Well, that does apply in this particular situation here. But something I want you to remember as well, when I stated that if it's measurable is important. So we need to be able to measure how free cash flow operates year after year of your overall business. And you'll begin to see why it is the ultimate driver of business value. But in order to basically start off with understanding understanding how this is an ultimate driver, it's probably clear to have a clear understanding of what exactly is free cash flow. And a simple way of explaining it is that is the cash that the company produces through its operations. Right? So it's less the cost of the expenditures and on your assets. Or in other words, free cash flow is the cash that's left over after your company pays for your operating expenses as well as your capital expenditures. And capital expenditures is another acronym that we'll discuss later on, which is CapEx. So let's get started. So in order to understand a company's sustainable cash flow, you have to begin with the analysis of net income. So I'm going to jump in right in the middle of this slide where it reads, now if you go back, and the slide is as far as net income. So net income, as you will see here, that is derived off of your income statement. To take the net income, we would add back in your depreciation and amortization, make your changes that you occur with your working capital, and that gives you your cash from, it will provide you with your cash from operations. But you're not done there because as I mentioned to you, after you've taken care of all of your expenses and your capital expenditures, that's when you get free cash flow. So at the very top of the slide, you'll see cash from operations, less capital expenditures. And just to give you a quick overview, capital expenditure things such as buying a building, land, machinery, et cetera. Those are the things that fall into capital expenditures. And we'll discuss that a little more as far as a driver later in the presentation. But for right now, just understand that your cash from operations less your capital expenditure leaves you with your free cash flow, which is extremely important. Because as your free cash flow continues to grow, what happens is that the larger your free cash flow, the larger your multiple, the larger your company, and that's essentially what you want to do. So when I state that it's measurable is important, you need to be able to measure how your free cash flow is continuing to grow. Now, I stated that I wanted to start right in the middle of the slide and start with net income, but I think it's also important to have a clear understanding. How do you come up with your net income? Because not everybody is as in doing with the accounting as some. So if we go to the next slide, or as I like to tell my clients, let's take it back a little and let's look at the net income. So as I mentioned, the net income comes from your income statement, and it starts off with that top line item, which is revenues. And everyone, I'm pretty sure on this webinar is well aware where their revenues can be found, because that's something that you watch consistently. But one thing I will say that, and Pat, you may agree with me on this as well, dealing with a number of business owners on their businesses, they often look at revenue as a correlation as far as what their value of their business is. Sometimes it's true, but oftentimes it's not. And you'll see why as we go along, is that they don't necessarily correlate. And the reason for that is that revenue line is a very important line, but there's so many other things that impact that revenue to derive your value. First step is, after you have identified your revenue, you'll see that you have cost of goods sold. So you subtract that from your revenues, and that gives you your gross profit. From gross profit, you take out your operating expenses. And operating expenses can consist of your rent, your telephone bill, your accounting, your marketing and advertising, et cetera. Those are your operating expenses. And that provides you, and it gives you your earnings before interest, taxes, depreciation, amortization, which is a valuation terminology metric we use as EBITDA. Now you take out your depreciation and amortization, and that leaves you with your earnings before interest and taxes, or your operating profit. And just like anything else, the government and your interest, you take out your taxes and your interest, and that leaves you with your net income. So not to be confused on this, if you go back one slide, remember I said just in the income statement, I said you're going to take out the depreciation and amortization, but then on this slide, I said you're going to add it back in. The reason why you do that, because depreciation is not an actual cash. Depreciation is already an asset that you've already acquired. And over several years, you depreciate that particular asset. So that asset is helping you create that income. So you can add that back onto your net income to give you that information as far as your cash from operations. Hopefully that makes sense, and I didn't confuse anyone on that.
All right. Well, thank you, Stephen. I might just go back and talk a little bit about EBITDA. You can tell you're from New Jersey because you say EBITDA, and in Minnesota we like to elongate all our vowels. So here it's EBITDA. But EBITDA is a very important terminology in business valuation, and people that are operating the sales of businesses or business brokers, they always talk in terms of EBITDA and using a multiple of EBITDA to really estimate what the value of a business is. Sometimes you'll hear 4 times EBITDA, or maybe up to 7 or 8 times EBITDA as a multiple being used to value a business. And you'll see that as well in business valuation. If you ever get a chance to see your ESOP valuations, a lot of times you'll see, at least as one of the methodologies of estimating value, is a multiple of EBITDA. So I want to take this and talk a little bit about value now and defining value. And I always use this very simple equation, which for those of you who have taken finance will recognize this as what's known as the Gordon growth model. But this basically says that value is a function of 3 factors. Free cash flow, which Stephen has talked about for a little bit. Number 2, the required rate of return, which is how we measure risk in business valuation. And number 3, the sustainable growth rate. Companies that grow faster tend to have higher multiples and higher values as opposed to companies that aren't growing or might be declining. And I think that makes a lot of sense. It's very intuitive for people to understand that fast-growing companies have higher values than slow-growing companies. So this is a equation. It's free cash flow in the numerator and K minus G in the denominator. K minus G is the required rate of return minus the growth rate. And sometimes we call that a cap rate, and I'll explain that in a minute. But first I want to talk a little bit about risk. Risk is directly related to the multiple that will be applied to a business. So a way to think about risk is how much or what rate of return do you need to incent you in order to make an investment. And the higher the risk in a business or the higher the risk in an investment, the higher the rate of return that you will require in order to make that investment. So there's this inverse relationship between the risk rate or the required rate of return and value. So the higher the risk, the lower the value, and vice versa. Some of the things that we talk about in smaller businesses, or any business for that matter, are some concentrations or risk concentrations. So if a company generates most of its revenues from one or more one or just a few customers, that's going to be pretty risky, because if you lose that contract or if you lose that customer, you're going to have a significant financial impact. So there's a lot of risk there. Another one might be dependence on key people. If one or two people bring in most of the business or are responsible for a large portion of the operations, that might generate some risk, and you might want a higher rate of return to compensate you for that risk. So this is a real good equation to come back to. Value is equal to free cash flow divided by K, the risk factor, minus the growth rate. So let's just say, for instance, that we have free cash flow of $100, or it could be $100 million or $100,000. And your required rate of return is 20%. In other words, you have a small business, it's fairly risky. You've done some analysis, you've looked at comparable investments, and you decide that 20% is the appropriate discount rate in order to value this business. If the sustainable growth rate, and this typically is a long-term growth rate, we'll look at something like inflation plus population growth, but usually when we're doing something that is sustainable, we'll look at a 3 to 4% growth rate. So if, let's say the growth rate's 4%, so now I have 20% for my discount rate or required rate of return and 4% for my growth rate. That means my cap rate is 16%. So the denominator is 16%. If I divide 1 by 16%, that gives me a multiple of about 6 times. So just a way of getting to these multiples that we use in business valuation, they basically derives from this formula, or a form of this formula. And Stephen mentioned the valuation is actually a little more complicated than this. We'll look at typically a discounted cash flow for purposes of valuing ESOPs, which will estimate cash flows in the future. And maybe they're growing faster than the long-term growth rate. Maybe they're not growing quite as fast, but it gives you a lot more flexibility in your growth rate going forward. And that might be fairly technical, but wanted to spend a little time here letting you know how this formula works. So we're going to talk a little bit about each of these items, these value drivers. Stephen, I'll just let you kind of introduce this if you'd like.
Sure. And the way that this slide is set up, what impacts value. Interesting, you look at all 6 of these buckets here, they all impact value in some form or another. And it's important for you to have a clear understanding, not only what they are or where they're located, is just how they interrelate with one another. The first one is revenue. And as I shared with you before, a revenue you can find from your income statement is that number 1 top line. So if you recall, I stated that revenue sometimes is translated to the value of your company, and that's not always the case. And the reason for that is the very next bucket, which is expenses. So imagine that you have a revenue line that continues to grow every single year. The challenge that a number of businesses run into oftentimes is that their expenses now take on a new life of its own. And how your expenses are run can have a significant impact on your business value. So your revenue line can continue to grow, but if your expenses are starting to outperform the growth rate of your revenue line, that will eventually bring down your net income. Your net income starts to reduce, and then obviously you're focusing on your free cash flow. That can have a significant impact. So you need to be able to monitor not only just your revenue line growing, but also monitor your expense line as well. And we'll go into ways that you can work on that. The next bucket is your capital expenditures. Now, your capital expenditures comes from your cash flow statement. And we'll go into detail as far as your CapEx as well. The next bucket is working capital. And working capital is definitely your current assets minus your current liabilities from the prior year. The difference between two is the changes in your working capital, which you would utilize in identifying your cash from operations. Your balance sheet, well, the balance sheet is that. It comes from your balance sheet. But the next bucket, which is interesting, and Pat talked about the risk of your company. Well, there's business risk, and it doesn't appear on your financial statements. It's a risk that has an impact on probably all five previous buckets as well, because there's different things that can affect each one, such as loss of customers, increase of production cost, cash flow problems. You can have litigation claims problems, increase in market competition, decrease in profitability. So the list can go on and on. So things such as business risk, someone needs to be on top of that as well, because that will ultimately have an impact on your business. Okay?
Thank you. But we want to talk a little bit about measurement. And when we get into aligning the company's value proposition with incenting your employees and your management, we want to talk a little bit about what makes sense to measure. And I think, especially when you get into companies that have a lot of accountants or finance people, they like to measure everything. Well, I'd like to suggest that you should really just measure what matters. You can measure whatever you want, but what matters for measurement? Well, if you look back at the valuation equation and cash flow definitions, you want to measure the things that matter. And this will differ from business to business. Some items are more important to measure than others. A business like mine, a consulting firm, we like to measure chargeable hours versus hours that aren't chargeable. For a lot of businesses that sell products, you're going to want to measure gross product, or gross profit, I should say, by product, as something that will really drive cash flow. As far as measurement, you want it to be accurate. Make sure that you have the data that you need and that you're using a system that maintains the accuracy of the data. Measurement should be data-driven. A lot of companies have good data. A lot of companies do not have good data, but you really need to have good information in order to make good measurement. What's measured should be communicated. It should be visible to all your people that it's impacting. It should be reviewed. It's just something that should be front and center for a business. If you're measuring important things and you want everyone to row the boat in the direction of value enhancement, you need to communicate the results, where you've maybe been short, where you've exceeded expectations, and determine ways to improve things going forward. Measurement should provide a basis for accountability, and this should be driven by people that actually can impact the particular measurement. In other words, you're not going to have someone in your accounting department be accountable, maybe a bad example, but for revenue. If they're not selling the product, you don't want the whole company to be measured based on sales, but certainly that would be the case for your sales force. Measurement should also provide a basis for the reward. If you hit your goals, it should be rewarded. If these goals increase value or have the basis for increasing value, then you want to align the rewards, again, with the measurement and reward the people for making those changes that will impact on value. All right, so this slide next is basically just a placeholder. We're going to talk about the income statement and capital expenditures next, and how these items really drive value in most organizations. I'm going to talk a little bit about revenue. So revenue, we call that top line. The reason it's called top line is because when you look at an income statement, is the top line on that statement. Well, how do you grow revenue, and how do you grow revenue in a way that drives value? And Stephen mentioned it a couple of times. Driving revenue just for the sake of revenue does not grow value necessarily. You want to grow profits, and you want it to grow free cash flow. So you can sell as much as you want, but if you're not making a profit, it's not going to translate into value growth. So some different ways to think about revenue: market share growth. Increasing your market share basically means taking market share away from other competitors. It is increasing your share of the pie in the marketplace. If you sell widgets and there are 100 widgets sold per year and you have 20 widgets, you have 20% of the market. Well, for you to grow that, you either need to expand the pie, expand the market, or
Pat?
yes, sir, or take away
So,
market from someone else. Are we okay?
yeah, we
Stephen?
paused there for a brief moment there, but I think we're okay now.
Okay, I noticed that my internet was unstable, so hopefully it's good now.
No,
Thank
you were hitting a point that you wanted everybody to gravitate towards. So that was great.
Thank you. All right, so wallet share growth means that you're increasing the share of revenue from each client. In other words, if they spend, say they spend $1 million a year on product and you get 50% of that, well, if you can develop a product or a market so that you get more money from that particular customer, that's called wallet share growth. And that kind of goes into the cross-selling. If you're already selling into a customer, it's generally easier to find opportunities to sell more to that particular customer than to actually find another customer in which you can sell product to. It's easier to sell to existing customers than to find new customers. That brings me back to new accounts and customers. Obviously, you want to be on the prospect and looking for new accounts and have a robust way of going after new customers. But just as important is retaining your current customers, because again, it's more expensive to find a new customer generally than retaining your current customers. And so you want to do what you can to make sure they're happy, have constant communication with your current customers, see if they're enjoying buying what they're buying from you. If there's anything you can do better, I think that's a conversation, especially in times like today, where it might be difficult to hold on to business or to keep businesses growing. I think it's very important in this time and age with the pandemic that we currently have to retain your current customers. I don't know, Stephen, do you want to add anything to this slide or would you like to take the next one?
I'll go on to the next one. I think you covered it really well, and it just made me start thinking, actually going into the expenses and the situation that we are currently in the pandemic. It makes you reevaluate how you go about your daily activities of growing your overall business. And I talked about expenses earlier, of certain things that you need to monitor. And the first bullet point we have is reduce supply chain and lead times. And it reminds me of a software that some companies are utilizing right now, and all softwares don't fit every particular company, but it gives you at least an idea of different things that you could possibly be doing. And one is promoting visibility with your suppliers. And what that does is it allows them to check in on your inventory at real time so that they can have a better understanding of your current situation and plan. And it basically helps you to plan ahead for your future demand. So that helps in your lead time as well, instead of going back and forth. That ties into your IT department, if you think about it, because of the mere fact that they're the ones that have a more or less a pulse as far as what's going on and what kind of software is out there can help streamline your supply chain process. So instead of utilizing your IT people for being reactive to some of the things, let's try to be a little proactive. Sit down with them. Especially this time now, this would probably be a great time to really sit down with your IT department and brainstorm what kind of things could we be doing to help reduce the supply chain and the lead times. And you may be able to identify some other things that you could improve your process and your equipment efficiency by working with that group as well. Another bullet is right people, right price. Now that can be taken in a variety of different ways. And one way of right people, right price is finding the right people that you want to have a part of your team, your right of your organization. You probably have great people working for you right now, but if you are in the process of trying to bring in more people, you want to make sure you have the right person there, because you're going to have to train those individuals. And if you're going to spend that man time and power and sweat equity into training these individuals, you want to make sure that they're the right people, but you don't want to bring them in at the wrong price either, because that also ties into your overall expenses. And then, of course, you have cost hawking, which is something Pat and I have been discussing about in finding the right types of products that are out there. And I know, Pat, you've had some experience with cost hawking and some of the valuation that you've done.
I have. And cost talking basically is, are you going to pit one supplier against another in order to get the lowest possible price? And what I tell people is I think you really have to be careful with that, because especially in today's environment, you want to have good, solid vendors, good, solid suppliers, and make them, I think, a partner in your organization and a partner in basically raising all boats. So it's one thing to lower costs, but you want to make sure that you keep your vendors happy, so that, if times do get tough, they'll continue to supply you and continue to help you with your business, finding the right ways forward and finding the right solutions that you need. You want someone that you can work with who's not always going to think, oh, they just want to keep pushing down the cost, pushing down what I'm able to do. It's just something I try to have people keep in mind as they're looking at lowering costs. So anyway, Stephen, you want to take on capital expenditures a little bit?
So capital expenditures, and if it's okay, I'm going to spend a little bit of time here. I know you only see 2 bullet points, but what I'm going to go over pulls both of those bullet points, calculate return on investment, as well as stretch out the useful life. Now, CapEx, as I mentioned, free cash flow is extremely important, but so is capital expenditures. And just give you a definition, and I'll just call it CapEx going forward, just to keep it flowing smoothly. So CapEx flows from the cash flow statement, as I mentioned to you earlier, and it flows from comes from the cash flow statement, and it flows onto your balance sheet. So once it's capitalized, the value of the asset that you've acquired, it is slowly reduced over time, right? So that is called your depreciation expense. Now, therefore, that depreciation expense is then used to better reflect the expense and the value of that long-term asset that you have that relates to your revenue that it generates. So the effects of CapEx really comes down to largely how you categorize your CapEx and how the company is spending. So there's 2 different ways that you could actually use your CapEx spending. You could utilize it for maintenance, or you could use it for growth and productivity purposes. So a company, let's just say, that uses most of its annual CapEx to maintain the production and profitability with a higher annual maintenance cost, typically, from a valuation standpoint, has a lower valuation than a company that does not have such a high annual maintenance cost. So a company with a lower annual maintenance cost can use its CapEx toward increasing its revenue and its productivity. So no matter the use, essentially, of the annual CapEx that you have, it's still reported as an expenditure on your income statement. And it is calculated as a percentage of your annual revenue that may potentially reduce the profit, as I mentioned, for that fiscal year. And it could also negatively impact the company's valuation. So companies with more CapEx spending, essentially, for productivity may see more of an increase in their revenue as a result of the purchases that produce that increase in their valuation. So I'm going to give you an example, and these are just broad hypothetical examples. So let's just imagine that there's a company, a printing company, okay? So that particular company requires annual maintenance on its machines. So that allows the shop to maintain their production but it doesn't increase their revenue, essentially, or their profit, for that matter. Now, the maintenance qualifies as CapEx, but it is reported as an expenditure, as I mentioned earlier, on their income statement, and it reduces their physical profit, and then ultimately it reduces their valuation of the company. Now, another company, let's just say this is a retail clothing store. That particular store has very little annual maintenance, right? So with the majority of their CapEx that they have to spend on productivity and growth purposes. So while their CapEx is also reported on their expenditure, on their income statement, that expense results in an increase of revenue and profits. So that increases the company's valuation. So why did I give those two examples? Because if you take a look at the calculation of return on your investment and stretch out the useful life of your machinery, that can have a significant impact on your profit line, which ultimately is your return on your investment and where you're spending your money. So not only are you going to be in charge of just looking at the revenue line, but you also have to maintain your expenses, but then you have your CapEx on what you're building, funding back into your company, and making certain that those dollars are allocated in the appropriate way that can see a higher return on your investment. And perhaps instead of, does it make sense to buy a new machinery product as opposed to spending the amount of money into the same product and not increasing your revenue or your profit? And at the same time, if you bought something new, are you going to hit your break-even point? So there's a lot of moving parts to this, but these are things that is going to be extremely important as a value driver in an area, a key area, action area for you and your management team to discuss and try to figure out what's the best bang for your dollar when it comes to capital expenditures.
I'll just hit on a couple of things here while we're on the slide, Stephen, but we often talk about CapEx versus OpEx.
Oh, that's right.
And another thing that you can think about is if your CapEx will help you reduce your OpEx. In other words, I make an investment in some new machinery that maybe doesn't take as much labor to run. Well, then we can model that out and figure out if that's going to actually have an increase on value or not. And something to keep in mind is that if you run an ROI, and this might be a little too technical for some, but if your return on your investment is actually higher than your required rate of return. In other words, if your return on investment is 17, 18%, and what we've come up with for a cost of capital or a required rate of return is 10%, then you're actually adding value to the company because you're getting a return that's greater than your cost of capital.
Right.
So something that you can think about as you look at this. I'm going to move on. Unless you have
That's an
anything
excellent
else.
point. That's an excellent point. I forgot to mention that. That is true.
Yeah.
Very
Yeah.
good.
All right. So I'm just going to move on to the next slides here and talk a little bit about some of this ESOP-specific considerations.
Okay.
Talk a little bit about benefit level and cash management, which we'll cover in the next slides, and how those impact on valuation. So when we look at ESOP-specific value drivers, one of the things we look at, what is the benefit level? In other words, how much is the company going to contribute to the ESOP participants in terms of benefit level? And the contribution usually is measured in terms of a percentage of compensation. And for most companies, we typically see the benefit level for retirement and retirement planning typically to be in the 3 to 5% range. Well, if a company over allocates, sometimes that can create some long-term liquidity issues because there will be a bigger repurchase liability. Now, the repurchase liability is what the company has to buy back the stock in the ESOP. And if the company is over allocating, meaning putting more shares of stock into each participant's account, that repurchase liability is going to hit more quickly. And if values are rising quickly during that period of time, that may create some liquidity issues as the company needs to buy those back. It's required to buy those back as participants retire, or if they get to the point where they can take their investments out of the company and reallocate it towards publicly traded stocks. So that might be difficult to manage. It's real important that companies be able to forecast their future benefit level based on some modeling of future share price and payroll. And that modeling is really what should drive the organizational stance on target benefit levels. From a valuation standpoint, we will typically adjust the company's financial statements to a market level of ESOP benefit. Even though a company might want to give more benefit, sometimes we see companies with both an ESOP and a 401k match where the benefit gets up in the 10 to 15% range. Well, that's pretty strong. And certainly if you work for a company like that, it's great, but it does have an impact on the cash flow of the business. And when we look at the value of a business from a market standpoint, we'll typically adjust that downward towards something that's within a market level of benefit. Stephen, I guess I'll let you take the next slide.
So let me ask you a question more so.
Yes.
We were talking about the repurchase obligation. So what if you are a partial ESOP company? How does this impact their value from your experience?
Well, a partial ESOP, maybe the ESOP owns 30% of the stock. It'll just have a lesser obligation, a smaller obligation, because their piece of the pie is smaller than if they own 100%, obviously. Mm-hmm. But that's a good question. All right. How would you talk a little bit about cash management? What happens when you get too much cash in a business?
And it goes back to, remember where I stated at the very beginning, cash is king, right? Sometimes you can have too much cash and that's not a good thing for your company, because from a valuation standpoint is that you're not utilizing the resources that you actually have to help grow that overall business, which again, you want your free cash flow to grow, which creates a higher multiple, which creates a larger company. But if you're sitting on your cash and you're not reinvesting back into your company's not growing, your free cash flow starts to diminish, and then your multiples begin to drop down as well. So you get where this is going. So cash is king, but you should also utilize that cash appropriately. And we've outlined a couple of areas here just to take into consideration. One is acquisition. Right. So acquisition is always a very good thing. Either you're thinking of, if you have the cash available, you can think of something from a strategic standpoint or from a vertical. In fact, while we were working on this presentation, vertical, I have a client that is in the process right now of a vertical, and try not to use the name of the company right now. One is the supplier is the developer of parts, and the purchaser is the person that acquires the parts and incorporates them into their product, and then they sell. So essentially what they're interested in doing, the purchaser is buying the supplier, incorporating that into their one overall company now. So that reduces some of their overhead costs of buying the product directly from the supplier. Now the supplier is a part of their overall company. That should increase the market value of their overall company by a substantial amount. But that's a great way of utilizing the excess cash that they actually have on the company, as opposed to it just sitting dollar for dollar in your bank account. Another is organic growth, right? So organic growth is a unique one. I think over the years, especially when we talk about management, value-based management and culture and things of that nature, most companies that have been around for a long time, you'll see in their brochures, they'll state that they grew their company organically. Well, if you pull back the onion a little more, and in fact, you probably have seen this also, some companies, yes, they have grown organically, but they acquired a company and they incorporated them into their culture, and they call that organic growth. But organic growth, whether or not it's through an acquisition or if you train the people internally, organic growth is great. Now, by organic growth, you're also utilizing that cash to train those individuals, bringing in the right technology, bringing in the right resources to help train them and to make the company even more efficient. And that also increases the value of your overall business. There's different tools to drive cost savings. The alternative investment, cash in the bank does not generate a return, as I stated. So if you have excess amount of cash sitting there, you want to find the right tools and resources that are available out there to help you enhance the value of your overall company. The future cash flow forecasting and anticipating near-term repurchase liability. I know Pat just mentioned that. That's something that's a requirement. When people retire, you're going to need that cash in order to do this. So making sure that you allocate that amount of cash for events that would come about for the repurchase liability. And of course, you had deferred capital expenditures. So cash management is just as important component of your business as all the others that are out there. So there's not one that weighs more than the other, in my opinion. Pat, you may have a different opinion on this. But if you have the cash available, you make sure that you utilize it in the most productive and in most efficient way.
Yeah, what I'll say to add to this a little bit, Stephen, is when we look at valuations and we see a company that has excess cash on its balance sheet, that only gets added back to the value of the business dollar for dollar. So if there's a way for you to, whereas, earnings of a company get multiplied by a factor of 5, 6, or 7, 4, 5, 6, or 7. So if a company can find a way to take that cash and convert it into earnings going forward, whether that be through cost savings or through generating additional revenue, that's what it should use. That's what it should do in order to increase the value of the business. Because cash just sitting on the balance sheet doesn't do anything for the business. Of course, a business is going to need cash to run the business, to pay payroll, to pay its vendors. But when you get to a point where you have too much cash, that is actually a detriment to the overall value of the business. I mean, it's additive in that we add it to the valuation, but it's not growing the earnings of the business by sitting in a bank account.
Right. And I agree with you. That's so important. Cash is king, but at the exact same time, you need to use that king to do something productive for your overall business.
Yeah.
Now, I didn't really go into detail. I'm sorry, Pat. I didn't go into details about different tools that drive your cost savings. Do you have any particular nuggets that you can share with someone as far as things that you've seen in companies that they've used to drive cost savings?
Well, it's usually either new equipment or new technology.
Uh-huh.
In other words, whether it's systems to better measure items, or if it's machinery that replaces labor or can save on labor costs or save on overtime costs. Those are the tools. Usually, most of the companies I see, they're using some sort of IT or web-based tool to drive cost savings as they automate their organization. That's usually where you're going to see a lot of the cost savings.
Yeah, that's great. And that kind of goes back to what we were talking about, the supply chain, trying to find the right automated service that can be more efficient for you. And there's a number of different things there. But it really comes down to taking these bullet points that we talked about today, the 7 of them, and sitting down and with your management team and really understanding how all of that plays into your overall business, and also working with individuals like yourself to help identify from a valuation standpoint. You never want, especially from your CapEx perspective, whatever you're spending your money on, you want to try to make sure that it's accretive to your overall business as well.
Yeah. Well, it looks like we have a couple minutes left here, Stephen. I thought maybe we'd just go back to our value equation and just summarize a little bit. So, ways to increase the value, pretty simple. You can increase free cash flow. And when we talked about free cash flow, we talked about increasing revenue, reducing expense, which will increase net income, which then goes into the definition of cash from operations, right? We're going to add back depreciation and amortization because those are costs we made in the past, and now we're just accounting for the use of those assets. So that is a non-cash expense. And then from that, we take out capital expenditures. So another way to increase value is to actually reduce capital expenditures to the extent you can and to lengthen the lives of your existing assets or extend the lives, get more bang for the buck. If you can use that computer for 5 years instead of 3 years, or if you can use your machinery for 12 years instead of 10 by keeping it maintained, that will help to increase value. Another way is we didn't spend a ton of time on the risk rate, but another way to increase value is by reducing the risk, reducing the dependence on key people, having succession plans in place, reducing the dependence on key customers will help to reduce that risk rate. And then finally, another way is to increase your growth. Look for profitable growth in terms of revenue and cash flow. That will also help to increase the left side of this equation, or value, which really is the goal for all organizations, and especially ESOPs, is to increase the value of the company's stock. Anything?
Yeah, and I'm going to jump back into that risk just for a brief moment, because you hit on something that's extremely important, your customers. Think about where we are right now. One of the things that customers They just need to know that you're still there. And it would be imperative for you to just continue to reach out to your customers. Everything is based on your 80-20 rule, right? You have your 20% of your customers generate 80% of your revenue. Well, that 20% needs to expand out a lot more, because they think the more you reach out and you touch and you make sure you have the quality of your product, but you want to make sure that your clients are feeling that they are the most important clients that you actually have out there, and keeping them in line. And it doesn't take a whole lot. It doesn't tag into your bottom line here just by reaching out and making sure that those customers are there. Because when you start losing customers, that is a business risk, and that affects your required rate of return as well. The technology that you can have in your company is extremely important, which I can't really emphasize. Spending time with the group that you have as your IT can turn into be something invaluable over the next year, 3 to 5 years of being in front of different things at a certain time. That also can have an impact on your risk.
Thanks, Stephen. I'll just go to the end here. We do have a minute or two. Hopefully you can get your last few questions in here. We want to thank you for attending this session. Hopefully you got a few tidbits of information on how you can help increase your company's value. We'd like you to complete the session evaluation after this presentation is over. We really do appreciate your feedback. Thank you for your patience as we learned how to use this new technology in order to provide you with a presentation that you can use and hopefully take back to your organization. Stephen, you have anything else you'd like to add before we sign off?
I just appreciate your time, and completing the survey, hearing back from you would be greatly appreciated.
All right. Thanks, everyone, and enjoy the rest of the conference.